you're sitting on, say, $100,000 and all you want to do is protect it, right? You just want to protect that value. Where's the safe bet right now? What if you can afford to lose it though, Peter, and you're looking for the most exciting speculation?
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
My next guest is Peter Schiff, founder of Euro Pacific Capital, host of Schiff Radio and the Peter Schiff Show. Always has his finger on the pulse for a variety of macro trends. I enjoy talking to this guy every single time. It's all good. No, it's great to have you back on, Peter, because it's been a few months since we last spoke and so much has changed. What I really wanted to dig into today with you was, we're all investors, we're all victim to this media frenzy, the volatile nature of a new headline every day that can affect our decision-making. And it's so important to step back and think bigger picture if we're able to. So I wanted you to help my audience with that today. And, the first issue I want to talk about is it's captivating all of our attention is we don't know who's going to be in the White House in 2021. My question for you though, is if you're just taking even a 5-year time horizon, does it even matter, Peter? Will it make a difference?
Well, I think on the margin, it makes a difference, but I think big picture, not really. I mean, we're going to go over the edge of a cliff no matter who's driving the bus. The difference might be how much time is it before we get there? Right? Do we step on the accelerator and go off the cliff sooner, or do we keep a steady pace and go off, a little bit later? I think that's really the only difference. But so to me, while I would prefer not to have Joe Biden as president, I haven't been too enamored with Trump either. I mean, Trump has been very disappointing in a number of respects. And I don't expect a big change if for some crazy reason he's able to prove that there was some type of fraud in this election. I mean, I think the entire electoral process is a fraud to begin with. But be that as it may, I think it's still likely to assume that Biden is going to be the president. That has been my assumption since Trump was elected the first time. I always believed he would be a one-termer. I described him not as the next Ronald Reagan, but as the next Jimmy Carter. I think that forecast will probably end up being correct.
And when you say the only difference will be one will drive us off the cliff faster, are you referring to Biden?
Yes. I mean, Biden will step on the accelerator. The problem is the growth of government, the intrusion of government regulation and taxation and spending into the economy. And those trends will accelerate under Biden for sure. And as big as the deficits were, the budget deficits and the trade deficits under Trump, and they were enormous. We had records in both, really. I think that they'll be even worse under Biden. The one thing we may have going for us is that the Republicans will hold on to the Senate just barely. We have these runoff elections coming up in January in Georgia, where it looks like Biden narrowly beat Trump in Georgia. Maybe he did that without cheating. I don't know. But if he did, I mean, is it possible that the Democrats can also pick up those 2 Georgia Senate seats? I think the odds are that they will not. I mean, they have to win both to get control. So if the Republicans just win one of those seats, then they maintain a slim majority. So I think the odds are that the Republicans will probably actually win both of them, but at least maybe one. So that will have a little bit of a restraint, but not much. I mean, we're still going to have big increases in government spending, even if some of the Republicans are going to push back against the big deficits, when they didn't do it when Trump was the president, but maybe some of them will find their backbone now that they're in the opposition. There are enough very liberal Republicans that will cross party lines and work in solidarity with the Democrats to approve increases in government spending and perhaps also increases in taxes on corporations and the wealthy, if it is perceived that those extra taxes will somehow benefit the middle class and the poor.
Right. And that kind of feeds into my next question. What, can we expect to see more of next year, right? Likely, inevitably more spending, potentially more taxation, although that could be a bit of a challenge to get through, and then potentially more regulation.
Well, we know we're going to get a lot more regulation. I mean, that's a sure thing. In fact, a lot of the deregulation that we got under Trump was accomplished by executive order. And I would imagine pretty much all of that would be reversed by Biden, probably, his first week on the job, if not his first day on the job. Plus, there's also a lot of other regulations that Biden is going to be pressured into implementing via executive order. I think a lot of them may have to do with the so-called systemic racism that supposedly exists in the United States. So I think there's going to be a lot of executive orders somehow targeting a remedy for that situation, which I think is going to be very problematic for American business and make businesses far less competitive than they already are, which will just worsen our trade position and make it harder for people to find jobs. I do think that we will get an increase in the federal minimum wage under Biden. There are certainly enough Senate Republicans that would go along with that to make that happen. That's going to be a big negative for the labor market, as if there weren't enough negatives there. So we're going to get that. I think we will have some higher taxes on the rich and the corporations. I mean, after all, even George Bush, I'm talking about senior now, George Herbert Walker Bush, he ran on a campaign of read my lips, no new taxes. He was a Republican and he raised taxes. So if Biden ran promising to raise taxes, why wouldn't he deliver on that promise? So I think that he will. I mean, the deficits are enormous. So there's going to be some tax hikes, but they won't be nearly enough to cover the increase in government spending. So most of the money is going to be printed. It'll be borrowed and then printed by the Fed because there aren't enough legitimate sources of revenue to fund the borrowing. So the Fed will just monetize all the debt, which means even more inflation and a weaker dollar than what we've already experienced, which, again, is not that much. The dollar has been weakening this year, but it's barely gone down. We're just scratched the surface of what's going to happen.
So you're seeing inflation across the board, asset price inflation, monetary inflation, consumer price inflation, all the way across.
Well, I'm seeing inflation in that inflation is an expansion of the money supply, which is obviously what's going on. Quantitative easing has returned with a vengeance. QE4 or QE infinity, whatever we're going to call it, is already larger than QE 1, 2, and 3, which again was my forecast from the very beginning. I'm one of the few people that said that QE would be here indefinitely, that it was a never-ending process, and that QE4 would be bigger than the first three combined. And so now that we're there, this is massive inflation. That's what quantitative easing is. It's a euphemism for inflation. But inflation can affect asset prices and consumer prices in different ways and at different times. And when inflation is pushing up stock prices or real estate prices, you don't hear a lot of complaining because people think they're getting richer. It's not until the inflation starts to push up the cost of living, consumer good prices, that you get people complaining. And I think that's already happening, and that's going to happen more and more. What's happened recently with COVID has only accelerated the upward pressure on consumer prices because there's been a lot less production. Companies have shut down due to lockdown or just people not coming to work. So they haven't been productive. They haven't been in the market helping to produce goods and provide services. So we have a big, bottleneck, and supply chains are broken down to a degree. So there's not as much stuff being produced, but everybody is still consuming. In fact, a lot of people are consuming more now than they were when they still had jobs. A lot of people are getting more in unemployment benefits than they used to earn when they worked. Then, of course, you got a lot of people who are just not paying their rent. Well, that gives them a lot of extra money to buy other things. A lot of people have taken advantage of the reduction in interest rates to refinance their home mortgage or to borrow even more money against their houses. So people have a lot of cash to spend, but there's not a lot of stuff being made or produced. So prices have just got to go up. And the money printing is just going to go through the roof over the next few years, and that's just going to add fuel to that inflationary fire.
Do you have any advice, Peter, for somebody who's living in their house mortgage-free, fully paid off, looking at these interest rates, thinking, I'd be silly not to refinance my house right now?
Yeah, I think that the best thing that you can do, financially speaking, right, if you own a house, is to borrow money at these low interest rates. You can borrow money below 3% for 30 years. Why not do it? Now, a good, part of that would be, what do you do with the money? I mean, I would not advise somebody to go out and borrow hundreds of thousands of dollars against their house and just go spend it, right? Just have a big party, buy a bunch of consumer goods, depreciating assets, buy a new car, do stuff like that. But if you take that money and you use it to accumulate other real assets, in particular, income producing assets, where you can get a reliable income that exceeds the cost of borrowing the money, that makes a lot of sense. Because the way homeowners are going to profit from their homes is not because they have a house that's gone up in value, but because they have debt that's gone down. Right? It's the dollar going down that's going to wipe out their debt. So you're going to profit from real estate as a debtor, not as an owner of real estate. The losers are the lenders. Whoever loans you money against your real estate collateral, it's the lender who is going to suffer a significant loss of purchasing power. Because even if you repay the loan, you're going to repay it in money that barely buys anything compared to what it bought when he loaned it to you. Yeah. So their loss is your gain. That's how inflation works.
Yeah, and that's been the story of how my generation of parents retired, mainly on the back of that home equity loan, right? Peter, now when you reference income producing assets, can you give me any examples? What comes to mind?
Well, for me, at least with what I'm doing, I buy a lot of income producing non-US stocks, companies that have dividend yields 4, 5, 6, 7, 8, 9, 10%, right? Those yields are more than sufficient to cover the interest on a home mortgage. And I think that as the dollar falls, the value of these stocks, even in local currencies, will rise rather substantially. But in terms of dollars, the gain will even be more dramatic than that. So I think people can take advantage of that situation, to grow their net worths by borrowing money. But you have to understand the risks. I mean, obviously, if the assets that you buy with borrowed money go down, you still have to repay the loan. Now, it's easier than repaying it if you just bought consumer goods, or took a vacation, where it's worth zero. The assets won't be worth nothing, even if they go down. They're not going to zero, the way a vacation would. But bear the risks in mind. And of course, if the income goes down, if some of the stocks that we're buying, if their earnings go down and they have to cut their dividends, then maybe all of a sudden you won't have enough money to make the mortgage payment, and you'll have to, come up with a difference out of pocket. So you have to be cognizant of what the risks are. But I think the rewards are dramatic. So do some serious thinking. And people, if you're up in Canada, I've been going to the Cambridge House events now for years, talking about, hey, we're going to get registered in Canada. Well, IROC finally approved me a couple months back, I think. And so we've been opening up Canadian accounts. We continue to do that. And so if you need help, building a portfolio, have somebody managing a portfolio of income producing assets, I can do that. I'm not as bearish on the Canadian dollar as I am on the US dollar, but I still believe the Canadian dollar will lose value. And I think it will lose a lot more value than the interest rates that you could borrow in today in that currency. So the advice makes sense for Canadians as well as for Americans.
Now, a question for you, Peter. So it's a good overview of the landscape. Now, if you're sitting on, say, $100,000 and all you want to do is protect it, right? You just want to protect that value, and your time horizon is 5 years. Where's the safe bet right now?
Well, if you're just looking to preserve purchasing power.
That's right.
I think just owning gold is probably the best way to do it. I mean, is there a chance that 5 years from now, gold can be below 1,900, which is about where it is now? Yeah, I mean, of course, there's always that risk. But I think the odds are much higher that it will be worth considerably more. Now, could it go down? it's possible. But I weigh that against the odds of other fiat currencies losing purchasing power, meaning if I buried a US dollar or a Canadian dollar in the ground today and I dug it up in 5 years and I went to buy stuff, how much would it buy relative to what it bought when I buried it? I think gold buried in the ground today will buy a lot more when you dig it up in 5 years than will your dollars or Canadian dollars. Now, you could say, well, you don't have to bury it in the ground. You can lend it out. True, but then you put it at risk. It's no longer safe.
Yeah.
The person who borrowed it could default. If you lend it to a government, which is supposedly low risk, the amount of interest that you're going to get is so negligible that I'm going to disregard it because the rates are so low. So from a perspective of just trying to preserve what you have, you could just buy yourself some gold. And gold has a pretty good track record of doing that. Although, the shorter the period of time, the less certain you become. So a 5-year period, it's possible that gold can go down during 5 years. But the next 5 years, I think that's very unlikely, given what's going to be happening with money printing and interest rates.
Just out of curiosity, Peter, the number of people these days that call me and are asking me about gold investing has gone up dramatically. Most of my viewers are pretty sophisticated gold investors, but not everybody is. Some are new to the game. I know there's not really a simple way to explain why gold, right? Why the yellow metal? Why does it store value like this? And when I'm asked that, I usually just say, look, it's 5,000 years of history. It's survived the rise and fall of hundreds of empires as a store of value. What's your answer to that question when people ask?
Well, the reason that gold stores its value or retains its value is that it doesn't decay or lose any of its properties over time. So, there are other assets, can't make that claim. So over time, they're going to be less valuable. They're going to decay. They're going to wear out. But what gold is really measuring, since it's so stable, is the value of the paper money that's being created. So the more money that's being printed, well, the more money you need to buy an ounce of gold, because the gold supply grows very slowly over time, maybe 1% a year, if that. And so if the money supply is growing by 10% or 20% a year, well, the price of gold must go up, because all gold is doing is measuring the value of the fiat currencies that central banks are creating. So it's not that the price of gold is going anywhere. It's staying the same. It's that the value of the money is going down, and the rising gold price is just letting you know how much value your money has lost. And when you have governments spending as much as they are, but they're not raising taxes to cover the cost, it's not like all that government is free. We don't get it for nothing. We have to pay for it somehow, and we pay for it through inflation. The government's not taking our money the way they would with legitimate taxes. They're taking our purchasing power. They're printing money and then giving it to other people to spend. Well, those other people bid up prices because they're not adding goods and services to the economy. They're just taking out some of the goods and services that other people have already put in. And so you're just dividing that pie among more people. So the prices go up, and then you end up consuming less because other people consume more. And the way you consume less is, well, the prices go up and everybody pays more and gets less stuff.
Now, I want to jump back to that question in a minute, but just based off something you said here, and a tweet you sent out, I think a couple of days ago, talking about if Biden's elected, one of his first actions might be a complete government-funded shutdown for 4 to 6 weeks. I mean, just sending essentially vacation pay to everybody. If that occurs, Peter, would you expect it to fuel another rally in the market from people that are just suddenly sitting on income they didn't earn and they might as well gamble with it?
Well, first of all, Biden didn't recommend that. It was some guy that is on his transition team for COVID. And that's what this guy was saying. So whether Biden is going to take his advice or not, we'll have to see. But assuming that he did, I mean, of course, that would be, a disaster to have the entire nation just ordered home. I don't even think that'd be constitutional, but, the government does a lot of things that I don't think are constitutional, yet they get away from it. There's a difference between what states are able to do and what the federal government can do, because states are bound by their own constitutions. The federal government is bound by the U.S. Constitution, which clearly does not authorize the U.S. government to do anything like that. But, you know, the Constitution hasn't stopped them from doing illegal stuff in the past, so it probably won't stop them from doing it in the future. But I can certainly see the public wanting this type of shutdown, because the government is promising that everybody's going to get paid, even if they don't work. And so I think if you told people that they can have a 4 to 6 week paid vacation, most people would want it rather than 4 to 6 weeks of work, especially if you tell them they're going to get paid more not to work than they would have been paid had they had to go to work. So, you know, there's going to be a political cry for this type of, you know, program, to the extent that people think it's free, which unfortunately they do. But, you know, it's your question about the market. Look, could it be good for all those stay-at-home stocks? Well, it could, right? All the stocks where you don't have to leave your house to spend money, right? You could go online and spend a bunch of money. So those businesses have been benefiting from the perception that this is good for them.
Right.
But, you know, maybe the stock market bubble will have popped before then. I mean, you just never know. The market is so massively overvalued, it can collapse at any minute. I mean, the only thing propping it up is the Fed, but I don't think that that can last indefinitely. I mean, at some point, you know, the illusion is going to wear off, and people are going to see reality.
Yeah. Okay. Now back to a previous question I asked. You know, you had $100,000 in value. Your only goal is to preserve that purchasing power. Your answer was gold. Probably, yes, anything can happen, but probably your safest bet on that 5-year time horizon. What if you can afford to lose it though, Peter, and you're looking for the most exciting speculation? Same time horizon. You got $100,000. What do you do with it?
Well, yeah, there at that point, it's kind of a similar answer, only a more risky way to approach it. And that would be the mining stocks, the gold mining stocks, silver mining stocks. You know, if the price of gold, let's say, were to double over the next 5 years, which I think is a conservative estimate of where it's going to go. But if the price of gold were to double from here, that would put it at close to $4,000 an ounce. I think that would result in at least a 5-fold increase in your typical gold stock, maybe more. So there's a lot of gains there. And a lot of these stocks are already paying dividends now. They're paying dividends that are higher than what you can get in government bonds. So you don't give up your income. You can still get income owning gold stocks. I mean, if you own the senior producers, I mean, if you go and you get the juniors and the exploration companies, you're not going to get any dividends. But, you know, I recommend that people build a portfolio that includes not only the seniors and some of the royalty companies, which in a way take a lot of the risk. There's still a bunch of risk, but they take a lot of the risk associated with the cost of production off the table when you're just streaming the revenues. But you get some of the streamers, then you get some mid-tier companies, and then you can buy some juniors and some exploration companies and really build a good portfolio that gets you well diversified in that space. You know, we have separately managed accounts at Euro Pacific that Canadians can take advantage of now by opening up separately managed accounts with us that we manage. Adrian Day is the portfolio manager for all of our gold-focused strategies. We do have a mutual fund that is not yet available to Canadians, but soon will be. We're in the process of making that fund available. Right now, it's available to Americans, but it will soon be available to Canadians as well. Same manager there is Adrian Day. And then, you know, beyond the metal stocks, you know, I would say also, you know, some of the industrial metals, energy stocks. I think anything that is inflation sensitive. I think the oil stocks have been particularly beaten up due to the COVID decrease in demand. Well, that demand is going to come back, but what's not going to come back is the supply. I think a lot of the weaker players are being shaken out of the market. I think U.S. production is not going to be anywhere near what it was when demand comes back. And I think a lot of that demand is going to come from the emerging economies in a much stronger way than it was before, which is also why I think the emerging market stocks also represent a pretty good speculative opportunity for people who want to be in the market and can afford to take some risk.
Now, are you looking at copper? Are you looking at nickel? Anything that's, the ingredients to the renewable energy?
Yeah, as a matter of fact, I recently invested in a royalty company that is focused on just those two metals, copper and nickel, because of their use with batteries for electric cars and things like that. But yeah, I think all these raw materials are going to be in a bull market. It's going to be the opposite of the type of bull market we have now, where it's financial assets. It's going to be real things that hurt when you drop them on your foot. Those are the things that you want to buy. People have been ignoring that stuff, but that's good opportunity. If you're a real long-term investor, you want to buy what nobody else is buying, and you want to sell what other people are buying if you still have it. I mean, if the smart money, I think, has sold a lot of these overpriced stocks a long time ago.
Right. Yeah. And that's one of the trickiest parts of being a contrarian investor is getting out when you're up. Right. And when are you, or how do you know, Peter? Because if I look at my portfolio today, I look really smart because I've started investing aggressively in the precious metal space 2-3 years ago. It looks great. Right. But, at what point and what are you going to be looking at to start? No one can call a top. I know that.
Yeah. Look, you don't know. I mean, a lot of these assets have already, exceeded what my expectations would have been. But, the nature of bubbles, it's very difficult. And the problem is, you're pricing stuff in fiat currencies that can collapse. Look, someone is offering me triple what I paid for my condo in Puerto Rico that I bought, 4 or 5 years ago? Or was it 6 years ago? 5-6 years ago. And I know it hasn't tripled in value. It's kind of crazy. And I should sell it. I mean, if I'm just going to be smart about it on a financial basis, but it's, it's more of an emotional thing because I kind of like it and I don't want to give it up. But I mean, maybe somebody's going to pry it away from me by just constantly offering more money. But you think about it, you see the price. And I think a lot of people end up in that situation with their stocks. I mean, they've gone up. But psychologically, they don't want to part with them because they think they're going to keep going up. But at least I get to use the condo and I get to enjoy the ocean and the breeze and the sound. You don't get much enjoyment out of a stock portfolio other than just looking at the numbers on a piece of paper, or not even a piece of paper anymore, on a computer screen. But I think there are bubbles all over the place, and the Fed has inflated them all. With help from other central banks. But I think if you price things in terms of gold, I really don't know what ultimately is going to happen in my condo in terms of dollars, but I am confident that in terms of gold, the price is going to go way down. Now, I already have a bunch of gold and I have a lot of gold stocks. So from a diversification perspective, I guess I don't need to buy that many more. But I'm pretty sure, I can look back on the relative price and, realize that, financially, I should have sold, but a lot of people don't recognize that. I mean, they still are. I think the people who are the most delusional are the Bitcoin holders. Bitcoin is at a new high as I'm speaking. Well, not a new high because it still hasn't got to 20,000 yet, but it's getting close. I mean, it's almost back to 17,000.
Yeah.
So it's almost back to where it was 3 years ago. But of course, there was all sorts of irrational exuberance back then, and the price went down to almost 3,000. So we'll see what happens this time. But I mean, those people are completely delusional. I mean, I don't think I've ever seen a group of investors that were more confident that they were right and more confident that it was impossible that they could ever be wrong.